Hi guys, how are you doing? I hope you've had a wonderful day so far. I wanted to touch on the subject of fashion stocks. Fashion stocks have fallen quite a lot this year, and I thought would be a great exercise for me to show you how I go around valuing stocks, because as these companies decline in share price, their valuations become more attractive in terms of investment. So I thought I would run through how I value a stock in a very basic way so that it shows you how to value stocks for yourself. If that is what you wanted to do, if you wanted to invest in an individual stocks instead of sort of a broad market ETF, you kind of have to know how to value a stock. And some of the videos I've been watching online on YouTube are sort of how to calculate intrinsic value, a lot about discounted cash flow analysis. And I studied finance when I was in university. I'm an accountant, so I know how to do this sort of stuff. And it really interests me, and I'm really excited about it. So hopefully I'm going to show you a very, very basic way of doing it. And I actually just use this basic way. I don't use complicated discount cash flow, anything like that. I just tend to do a very, very simple method. And I come out with a number, which I call the Unorthodox Investor ratio, the UIR. And what it does is it brings out a percentage. And that percentage is kind of like an interest rate. You know, if you open up a bank account, they will say that the interest rate is 1% per year, and that's what you get on your money that you have sitting there. And that's kind of what I do when I invest in the stock market. I value the companies I invest in, and I calculate a percentage, and that's my interest rate of what I expect to get. Now, you might think, how high could those interest rates be? Well, actually, some of the stocks that I'm invested in right now, I'm calculating a return of about 25% per year, every year, if the company continues to perform that way. So it can be very lucrative, especially when the market goes down. So that brings me back to the focus of this video, fashion stocks. Now, they've all fallen quite a lot. So I wanted to kind of talk through 6 of them. So it might be a slightly longer video, but hopefully you can kind of stay with me and I'll show you about the valuations. We'll go through this as I do it. I haven't pre-prepared this. And this is one of the things I want to do on YouTube, is not pre-prepare too much. I want to show you exactly how I do everything I do, so that it's show how uncomplicated it is, how easy it is to do, and give you a sense of what to look for from a real perspective, So here we go. So let's start off. Let's get stuck right in, and I'll show you the 6 fashion stocks I wanted to look at. Now, they're broken down into 2 distinct groups, actually. So we've got Joules, Ted Baker, and Superdry are 3 fashion retailers. So they sell online, but they've got physical stores as well. In fact, Superdry does one of the least amount of online sales. It's very kind of focused in store on the high street. And those sort of, bricks and mortar retailers are the ones that are maybe potentially doing the worst at the moment, because people are buying, well, especially during COVID, people are buying more online. And that really hurt the bricks and mortar retailers. So that's half of the ones I wanted to look at. The others are Asos, Boohoo, and a smaller company called InStyle Group. So those are the 3 online-focused fashion retailers. Now, in my eyes, they kind of hold a little bit of an advantage because they've got quite an unlimited market. However, the bricks and mortar retailers also can have a bit of an advantage because they can exploit the online sales and really start to take market share from the sort of bigger players in the sector. So there is that. There's a kind of trade-off there. But if you're already established in the online space, it means that people already know about you. They feel comfortable shopping on your online shop. So there is that. Now let's dive straight in and do a valuation. I'll show you my Excel spreadsheet, which I just put together in about 5 minutes just before this video. I'm going to be looking at a few different attributes of the company, but things that are very easy to find and things that you can find yourself, within minutes, if not seconds. So I'm going to be looking at revenue, which is the total sales of a business. I'm going to be looking at profit, which is after you've made a sale and you've collected money from the customer, then there's all the costs associated with that, which is paying for the manufacturing of the product, paying staff, paying for delivery, paying for returns, and if you're a bricks and mortar retailer, paying for rent and things like that as well. So after all of that, you'll get your profit. Then I'm going to look at the market cap of the company as it is now. So on the stock market, investors value a company, and that is so people often just look at the share price, and the share price might be £1 per share or 100 pence per share, but actually that values the company maybe at £100 million. And so I'm going to be looking at the market cap, and that'll tell us our unorthodox investor ratio, our percentage, our interest rate, what return we are going to get from investing in that company. And that's what we're really interested in, is the return we're going to get. And then last but not least, I'm going to have a little look at debt as well, because debt is super important. I mean, a company can be making lots of profit and it's all, happy dandy, but actually if the company's got a lot of debt, it adds risk. And so we must look at debt just as that sort of extra risk factor. So let's go straight in, and I want to start at Asos, because this is something I've been wanting to do for a good month or so now, and I thought let's just do a video and show you guys at the same time, because I find it super interesting. So I hope you find it super interesting as well. So let's start with Asos. I'm going to open up one of my favourite websites, Hargreaves Lansdown. You can click on the wee search bar here, and the code is ASC for Asos. I'll click on Asos, and then you've got all these different tabs here. I'm going to click on Financials, and Financials will give us pretty much all of the info that we need. Now, all of this, I have to just say, is just a starting point, because I'm going to look at the figures from here, we're going to put them in, and we're going to have a look at our valuation that it spits out. Now, it's just going to give like a brief basic overview. Now, once I've done that, once I've got the brief basic overview, then later on, not in this video, but in my spare time, I'm going to go through the company accounts and I'm going to double check these figures, because they're not always correct. They're usually pretty good, but not always correct. You have to go directly to the company itself just to make sure, Okay, so we've got a revenue figure here. It's in millions, as you can see, so that's 3.91 billion. So that's what we're going to put in, 3.91. And in fact, what I've said here, let's just enlarge this a little bit so we can add a few extra points on. What I've said here is a 3-year average, actually. So let's have a little look. So it's 3.91, 3.26, and 2.7. So that's about 2, 5, 6. That's about 10 billion. Equals 10 billion divided by 3. But actually what I'm going to do, I'm going to go for the latest. I'm going to go for the latest revenue. So last year, because that we're still expecting these companies to grow. They all should be in growth phases, and we'll see by looking at the annual reports whether the company is slowing down in growth. But you can see Asos is continuing to grow. So I would expect that to be at least 3.9 billion next year, or this financial year. Next, we're going to be looking at the profit. Okay, so this is one of the ones that you do have to take with a pinch of salt. So we are going to go for a 3-year average here. So we've got 128, 113, and 24. So it equals 128 plus 113 plus 24. And we're going to divide that all by 3. So that would be the 3-year average there. And so the average profit is 88.3 million per year. So here we've got billion last year. So we've got in billion. So you can see by me not preparing this, it means that you really do get to see you really see kind of like how I do this here. So we're going to do revenue in billion because it's a much larger number. Profit for these companies we're going to do in million, and the market cap we're also going to do in million. So ideally you'd keep all of the all of them the same in the same format. So all we're sort of calculating here is profit and market cap. That's going to give us our unorthodox investor return. So that's why we're keeping both of these in million. I'll put in brackets here, 1,000,002. So we're going to look at we'll look at the debt first of Asos, because that's also here. Let's have a look. I've scrolled down. This website's really good, by the way, Hargreaves Lansdown. They give everything very succinctly. So you can see debt is going up. That's up to 764 million. So let's pop that in. There's a little bit of borrowing here as well, but we'll kind of, okay, we'll say that's an even 800 million. So we'll go 0.8. We'll keep that in billion as well. So let's just do that. And in billion. Okay, so, and then we're going to look at the market cap. So the market cap's actually on a different page. We need to go back to at a glance, and Hargreaves Lansdown will tell us the market cap. And this will give us our first valuation. So market capitalisation, £752 million. Okay, 752 million. And this gives us our unorthodox investor return of 11.7%. Now, basically what this means is I will look at this unorthodox investor ratio, and I will see, okay, so if I've invested in a stock and it's giving me a return of 8%, great, brilliant. But if I can replace that stock, if I can sell that stock that gives me an 8% return, and I can invest in a stock that gives me an 11.7% return, then I'm going to do that every day of the week, right? If you've got a bank account that pays you 8% interest, and you've got another bank account that pays you 11.7% interest, you're going to put all your money in the 11.7% interest bank account. That's just the way it's going to be. However, of course, you've got things in the stock market called risk, and you've got fluctuations, and that's the things that people get scared about and nervous about. And the things that are unpredictable, it's random. You get a lot of random fluctuations. But on average, as long as the company continues to perform, this is the percentage return I would be expecting. So as the share price continues to fall, the market cap will fall. So if I pop the market cap down at 700, that's almost a 10% decrease. You'll see the return goes up. If I pop it down even more, 650, you can see the percentage starts to go up. So the lower the share price goes, the greater the long-term return should be. Okay, let's check out Boohoo. So the reason I wanted to do this, just to sort of clarify again, is I wanted to compare these companies because I forgot to say, I've only got 5 companies here as opposed to 6. I'll explain that in just a moment. So the reason I wanted to compare these 5 companies is because at some point I will want to invest in one of these because the valuations are getting quite attractive. And I want to know which ones are the most attractive. Which one, so when I come to bite the bullet, which one or ones am I going to go for? Because it's important to know, because this is going to be like a sort of 3 to 5 year, maybe 10-year investment. It's not a short-term investment. It's not a trade. It's going to be a long-term investment, and I want this return that you can see here. So whichever's the highest, that could be the one I go for, unless it's saddled with a lot of debt. So I said I only have 5 here, yet I've got 6 on my watch list. The stock that I'm not going to be having a look at is Ted Baker, because they recently had an offer for the business, and so the share price has sort of plateaued here at the offer price. So unless that offer sort of falls through, then the share price is kind of fixed, and it's not worth investing in at this price. So I'm not going to be having a look at Ted Baker for now, but I thought I'd have it on the list because that's been on my personal watch list for a long time now, and I don't think I've ever invested. Not that I can remember anyway. I might have done, maybe in my sleep or something like that. I don't know. Okay, like the next one we're going to look at is Boohoo. So the 2 most exciting ones on the stock market, Asos and Boohoo. So let's have a look at Boohoo next. Again, we're going to go back to Hargreaves Lansdown. Boo is the code for Boohoo, if you want the short one. We're going to click on Boohoo and it will come up. So let's pop the market cap in first. 615 million. 615 million. Let's have a look at the financials. Click on the financials tab. And then we'll have a look at first the revenue. So again, you can see Boohoo is increasing in revenue, and it's actually a year ahead of Asos in terms of releasing results, although that doesn't matter too much. So we're going to say that's 2 billion because it's close enough to 2 billion that it sort of is. So you'll be able to see that it's actually half of the revenue of Asos, which I never really realised. I thought that Boohoo was a lot closer to Asos than that. The profit, now let's see what the profit is. Okay, so you can see that over the past year, Boohoo has made a loss. So we're gonna incorporate that in our 3-year average, right? So we're gonna say -4, 93, and 73. So we're gonna do equals -4 plus 73 plus 93. And oh, sorry, I'm gonna divide that by 3. And we're going to see that the profit is 54 million per year, because we're in millions, and when we're talking about profit, we're in millions, we're talking about market cap. And you can see the unorthodox investor return is 8.8%, so slightly lower than Asos. What that means is when I'm looking at these companies, depending on things like growth potential as well, which is kind of a little bit of a guess, but something that you do need to factor in as well, in your own way. There's no kind of financial way of really factoring that in. But if you look at the sort of the kind of market cap, the unorthodox investor return, Boohoo would need to fall a lot more. Let's see, down to sort of even 500. So that's about a 20% drop, and it's still got a lower return than Asos at these levels. So let's have a look at the debt. Scroll down here, we've got liabilities, we've got borrowings. So we've got current liabilities, which is short-term borrowings, which need to be repaid within 1 year. And then we've got non-current liabilities, which are long-term borrowings, which need to be repaid, which can be repaid more than 1 year. Sorry, couldn't really get the words out there. It's like so far away that I couldn't actually think about what it was. Okay, so let's take both of these into account. So we've got 111, I've got 47, so it's about 160 million worth of debt. So that's 0.16, because we're doing this in billion. Okay, let's have a look at InStyle Group. So InStyle Group is a company I came across relatively recently, and I just wanted to incorporate that in my analysis because it is an online clothing retailer and they are growing, and they're growing quite quickly. Of course, because when you're small, you can grow quite quickly and it's okay, but you can see the market capitalization is tiny here, 15.5 million. So we're going to put 15.5 there. And I just want to see kind of like how this company compares in its small size to these big companies, because there's a potential for a lot more growth with smaller companies, but only if it's safe. So let's have a wee look at the financials and see what we're up against here. So you can see the revenue is increasing, and we were at 57 million this year. So we're going to put in, so the revenue is 57 million. So I've got it in billion at the moment. 57 million isn't going to really look like much when it's in billion. So I'm going to put it 57 there. What I might do is I might move that down and put million. So let's put million there, just to show that that's a million instead of billion. And then we're going to use the profit as well, which is here. So you can see the last 3 years got minus 1.3. So let's see, equals minus 1.3 plus 0.6 and minus, and what was the next one? Minus 2.2 divided by 3. So we're at a loss. Okay, so we're getting a negative return here. Now, of course, that's never good. You never want a negative return. So if you held a stock for quite a long time, you're going to lose 6% a year. So you don't really want to do that. However, if you think that there's quite a lot of growth within the company and the company can make a profit, then the stock price could grow, and that's when a bit of speculation comes in. So I wanted to include that company because I want to compare the sales of the company with the market cap, and then compare that with Asos and Boohoo. So in fact, we can just do that just now. So what I want to see is let's do ITS InStyle Group, and we've got Asos. Let's compare Asos. So InStyle, we're going to do the last year's revenue divided by market cap. Okay, so we're getting, so the market cap is, so the revenue is 3.7 times the market cap. Okay, so let's do exactly the same calculation, but for Asos. So we want 7 and 7. That didn't work because I was selecting the wrong cell. Okay, and then what we need to do is we need to times that by, we'll need to divide that by 1,000. Or even, let's times it by 1,000. Okay, so we've got 520. So there we go. There's our comparison there. So Asos has got 5 times the amount of sales for its market cap, and InStyle has got 3.7 times the amount of sales for its market cap, which indicates that Asos is more undervalued because you're getting £5 of sales for every £1 you invest in the company. And if you're getting 11.7% profit, that means you're getting 10 pence for every £1 you invest in the company. Or you get 11.7 pence for every pound you invest in the company, if we're being realistic, okay? So it's just an interesting little comparison there to see how much in sales you're getting for every pound invested in the company. Okay, let's move on to some of the retailers, the brick and mortar retailers, Superdry and Joules. I want to have a look at these two because they've both fallen a lot and they're both quite low in the grand scheme of things. If you look at their share prices, let's have a little look. Sorry, I realise this video is going on quite a long time, so if you made it this far, really good on you, really good. In fact, you've made it so far, you should hit the subscribe button and like the video and even write a comment because that's impressive and I want to know who you are. And if you're some of my best pals, I like you even more. So let's have a look at Superdry because I wanted to just show you kind of what the sort of graphs are like. You can see it's just fallen quite a lot over the 5 years. You know, we're up at sort of £20 there, or 2,000 pence, and now down at £1.26. So look at the max graph, kind of the lowest it's ever been. And I'm going to guess the same for Joules, although I have not looked at the long-term graph. Let's have a look. 5 years, lowest point ever, max, lowest point ever, right? So whenever this sort of stuff happens, whenever the share price goes to the lowest point ever, it can mean a couple of things. Either the company is sort of dead in the water, it's going to go bankrupt, it's in serious trouble, or there's some serious opportunity available, right? And sometimes you just don't know which one it is. But for me, one of the telltale signs is that a lot of the fashion retailers, whether it's Superdry, whether it's Joules, whether it's Asos, whether it's Boohoo, you know, all of these companies are at rock bottom prices. And I just don't believe that every single fashion stock is going to go out of business. I just don't believe that for 2 seconds. So they might come off worse. They might have to take on lots of debt, and they might not make any profits in the future. But you can take that risk, and if it doesn't pay off, it's still at such a low price. You've got the margin for safety, margin of safety, even not margin for safety. But you'll have heard that a lot from lots of other YouTube videos. A margin of safety, and that's when you are getting a lot of value for your money. You're getting more value than you're paying out. And Warren Buffett always talks about buying $2 for $1. And that could be the case in some of these examples, which is why I wanted to analyze them. So let's have a look at Superdry next. Again, I'm going to go into Hargreaves Lansdown, Superdry, and we're going to have a look at the financials and the market cap. So market capitalization, 103.5 million. 103.5. So you can see they're all quite different. Asos valued quite highly, InStyle Group valued quite low. Let's have a look at the profit and revenue. So I'm going to click on financials on Hargreaves Lansdown. And let's have a look at revenue. So you can see the revenue has gone all over the place. It was up and now it's declining, which is really not a great sign. That means growth is going down, and the less money they make, the less profit they're going to make by quite a large factor. So that's really quite worrying unless they can kind of bring it back. So actually, I'm going to take the latest revenue figure again, which is 0.5 0.56 billion, so 0.56 billion, so you can see a lot less than Asos and Boohoo. But let's have a look at the profit. The profit's at the top. So the profit was minus 36, minus 143, minus 102 equals minus 36, minus 143, minus 102. Divided by 3, we're going to take the 3-year average. That's minus 93 million a year, giving us a return of minus 90.5%. Okay, so I've not really seen a stock that low before, hence why the share price is probably one of the lowest it's ever been. Let's move on to Joules. Normally when stocks are like that, I do tend to discount them quite quickly, but it's worth sort of, if it's a company you know quite well and you want to do a bit more research in, maybe worth looking at it. But those sort of negative figures do scare me quite a lot. So we've got market cap of 30.5 million. Let's check the revenue. So this company Joules is going to be more the same sort of size as InStyle group, rather than one of the big behemoths like Asos or Boohoo. So we can see the revenue is 199 million, so 0.199. The profit is, okay, so we've got 1 million minus 20 and plus 10 equals 1 minus 20 plus 10 divided by 3. Okay, so let's see. So we're at a negative 3 million profit per year on average, giving us negative 10% unorthodox investor return. And the last thing I wanted to also look at was debt as well. So I missed out Superdry. Let's have a look at Joules, and we can go back to Superdry. So we've got current liabilities and we've got non-current liabilities. So let's say approximately 55 million. So it's relatively low, but it's large for the size of the company. And we're going to have a look at Superdry as well. So if I just hit back, we should get to the financials, and we can just enter the debt for Superdry as well. So we can have a look at the current liabilities and the non-current liabilities. So we can see we've got 94 plus 175 equals 0.09 plus 0.175. So we can see that actually the debt, if we transfer that into millions, then the debt of Superdry is 270 million and the market cap is 103 million. And same with Joules, debt is about 55 million, we said, and the market cap is 30 million. So the debt is higher than the market cap, which is actually the same for Asos as well. The debt of 800 million is greater than the market cap of 750 million. And with Boohoo is the only favourable company when it comes to debt. You can see that the debt is 160 million versus a market cap of 615, which is why you have this sort of lower percentage, lower unorthodox investor return, because you get a lower return because it's a more sought after company. It's a higher valued company because it has lower debt. So there you go, guys. That's kind of what I look at when I'm looking at a company, especially when I'm comparing. So when I'm looking at these, I will look at sort of Asos has a higher profit margin here, right? And it's got a higher unorthodox investor return. If I put my money in there, I am expecting a higher return. The things I'm going to be looking at in the financial statements when I go away and do this in my own time will be the debt and seeing how that's growing and what, like, why, basically. Is it a problem? Is it always increasing? And is the company trying to get that down? And the next thing is I would be looking at the cash flow. So the company can make a profit of 88 million, but where's that money going? Is that money going to dividends? I don't think Asos have ever paid a dividend. And so, like, where's that 88 million going? Is it cash? Or is it going into sort of I don't know, rental properties like warehouses, where is that money going? Because if it's not coming back to investors, or if it's not going to some, growth within the company, then that's something that you're going to have to watch out for. Because if it's not coming back to investors, like literally where is it going? Like that percentage then does not exist. That 11.7% doesn't exist unless it's coming back to shareholders. Superdry, with its quite large debt burden and its negative return, its return of negative 90%, means if you hold Superdry for 1 year, I would expect that you would lose 90% of your money within a year, which is relatively scary, right? Hence why the share price is quite low. But I mean, what is low? If you invest £1,000, how much can you lose? £1,000. You can lose it all. So you can lose 100%. So it would be definitely one I would be very, very wary of. Even if you're a trader, I'd be quite worried about even trying to make a quick buck on this one, because you could end up losing a very quick buck. But who am I to say? I don't really know. I just work out these percentages, and I'm quite a logical person, so I just go with the numbers. And if you go with enough of the right numbers, it tends to work out. I watched a Warren Buffett interview recently, and it was his first ever interview, and it was on a channel called New Money, which is really, really good. And in that interview, Warren Buffett said, if you invest in, if you find a really, really good company with a good return, and you buy a few of those companies, then it's pretty much impossible to lose money. And so if you go with the numbers, you follow logic, then it's just the way to go. It's the way I do it. So hopefully that teaches you guys something about kind of how you work out the percentages, and what you can do as well is you can compare this to the other investments you've got. Like I said, if I've got another investment that's paying me 8% a year on average, then I might want to replace it with one that's paying me 11.7%, because that's an extra 3.7%, which adds up to a lot over a few years, right? So hopefully you found that really interesting. Like I said, hit the subscribe button and the like button and all that sort of stuff if you thought that was really good. That was a really long video, so I'm sorry that was so long, and if you've stuck with me to the end, wow, you are amazing. You are just incredible. So that was the longest video I've done, and there'll probably be more to come, because I love doing valuations. I love doing this valuation thing. So I will catch you on the next video. Have a wonderful week, and see you next time.